Hello, everyone. We are back with another very interesting webinar. My name is Kamal Manocha. I represent PMS AIF World. Over last 1.5 to 2 years, we have been doing many knowledge-centric webinars, and that is what has built name for us. Today, I can confidently say that we have become India's one of the most trusted platforms for making informed investment in the space of alternates. And in that regards, today we have a very, very interesting and special guest. Before I introduce our special guest, I would like to give a quick context of what we have been doing and how we have been approaching the space of investments. Anup, can you please keep yourself on mute? So, over last 2 decades of my personal experience, I realized that approaching investments from investors' perspective is very, very important. And simplifying investment hence becomes very, very important because investors like simplified things. And that is where we thought that when the space of mutual funds is being simplified because of technology and by regulator reducing the number of schemes, at the same time, the space of alternates can be simplified by bringing more content and analysis around it. And to build content and analysis, we started doing the webinar series. And in that webinar series, we again approached this from investors' perspective, where we found that investors, when they think of investing into any product, they approach it by understanding the product from 5P perspective. Those 5Ps are: who are the people behind this product? What is the philosophy of this product? What are the returns of this product? So which is performance of this product? Then what is the price of investing into this particular philosophy? What is the expense of that particular product? And then finally, what has been the portfolio construct? So these have been the 5Ps. And in that regards, today we will be discussing a very important P, which is philosophy, and the philosophy for IIFL, which has worked for IIFL AMC very well. Recently, we conducted India's top-notch awards in association with team we built with IIM Ahmedabad, and there IIFL AMC won award in the 5-year category. And the reason was its very, very credible investment philosophy, which is SCDB Framework. And that is the context of this webinar. And who pioneered this SCDB framework is Mr. Anup Maheshwari. And today we welcome him, and we are very, very delighted to have him on our platform for discussing and understanding the SCDB framework. Anup brings with him more than 21 years of experience. He has throughout worked with DSP equity mutual funds, and he worked there as associate vice president, and then he was working for many years managing equities into research, and then he was a CIO at DSP. He has been associated with IIFL AMC, and today he's CIO and joint CEO at IIFL AMC. And from him, we would like to understand what are his learnings over last more than 2 decades, which led him to discover the SCDB framework. And what is this SCDB framework, and how this SCDB framework is being applied by IIFL AMC in mutual funds as well as in managing the PMS. Over to you, Anup.
Great. Thank you so much, Kamal, for that introduction and for putting such a nice context to our discussion today. And a very warm welcome to everybody on this call. I'm delighted to have the opportunity to tell you a little bit more about our SCDB framework, how it's evolved, what is our thinking behind it. That's very important. And ultimately, we are fiduciaries of capital on your behalf. And therefore, it's very important to know on what basis we construct portfolios and what is the philosophy we use. So I've got a quick presentation, a few slides in it, and maybe I can just take you through that and through that to explain to you the journey as well as how we came upon this philosophy in the first place. So I will just share my screen. So let me just start straight into the philosophy itself, which is the SCDB framework. Now, you'll notice on the x-axis, there's something called return on equity, and on the y-axis, there's something called profit growth. So return on equity is nothing but the profits that the company is generating on the capital it deploys in the business. And profit growth, of course, we're all familiar with. Now, the genesis of this whole framework was that these two financial variables have a very strong correlation with shareholder value generation. So using these two variables, what we've tried to do is build the framework around it in terms of identifying businesses and constructing portfolios that can generate sustainable shareholder value creation. Now, you'll notice on the slide, we've got 15% return on equity and 15% profit growth mentioned. So the whole logic of that is if you look at the Sensex from a long-term point of view over the last 35 years, the average return on equity of companies in the Sensex has been close to around 15%. And the average profit growth has been close to 15% over a long period of time. And not surprisingly, therefore, even the market returns have been somewhere in the 14-15%-ish range. So using that as par for the course, what we did was we used the BSE 200 as an index. You could use whatever index. But using the BSE 200, we saw all the companies and mapped them out into these financial parameters. And we came up with these 4 quadrants in which we've aggregated the sectors. So on the upper right-hand quadrant is what we call the secular businesses, or the S in the SCDB framework. And the BSE 200 weight in this quadrant is about 34%. So just to explain how a company fits here is that it should have met the criteria of being above 15% return on equity and above 15% profit growth in at least 6 out of the last 10 years. So we look at 10-year rolling periods, and in at least 6 out of the last 10 years, you should have met, along these two financial parameters, depending on where you fell, you came into one of these 4 quadrants. So the secular businesses are the ones that have been able to generate sustainable return on equity and profit growth quite consistently over the last decade. Not surprisingly, there are a lot of consumption-oriented businesses here: autos, consumer discretionary, the entire financial services complex, and retail. Now, they make up 34% of the BSE 200, and I'll show you in subsequent slides why secular businesses have demonstrated the ability to consistently generate shareholder return. And therefore, what we try and do is make sure that the core of our portfolio is overweight on secular. So if the index weight is 34%, we want to make sure that our portfolio carries a higher than 34% weight. And that's what we call the core portfolio. Now, in a way, the opposite extreme of seculars are value traps. So value traps are businesses that have struggled to generate 15% return of profit or return on equity consistently over long periods of time. So they are businesses that they could have short cycles of performance, but the longer you tend to hold them, the worse off you tend to be. So that includes a fair number of the smaller PSU banks, oil and gas, telecom, utilities. These are all heavily regulated sectors. And therefore, not surprisingly, I mean, it's difficult for them to produce very high return on equities because most of it gets either regulated away or it's very capital intensive as a business. So what we try and do is ensure that we are below the BSE weight 24% in value traps. So just by being a little higher on seculars and lower on value traps, that itself, to our mind, is a source from a long-term point of view of generating slightly better return than the market. Then you have the other 2 quadrants, which are defensives. So on the lower right-hand side, you'll see defensives, 28% weight in the index. And that includes businesses that are high return on equity businesses, but relatively low on profit growth. So consumer staples fits here, healthcare, IT services, and media. And in a way, the opposite of that, in some ways, is cyclical businesses, all the economy sensitive businesses that tend to be more capital intensive. So the return on equity is lower, but they can go through high profit growth periods when a cycle is in their favor, something on the lines of what we're experiencing recently. So what we try and do in our framework is be tactical between these 2 segments. So we are active in our weight on defensives and cyclicals, depending on what sort of macro environment we're in. So that gives us the flexibility component of our portfolio construction to try and navigate through multiple cycles. So let me put in perspective, when you look at most of the fund managers in our community, they would tend to have, all fund managers have certain biases of style. And most of the style biases are split right in between actually on this. So the growth and quality sort of preferred investors would be more on the right-hand side, and the value preferring investors would be more on the left-hand side of this graph that you see in terms of their portfolio composition. Now, there's nothing wrong in either strategy. All these strategies work over long periods of time eventually. But the challenge is that they tend to produce extreme performances in certain conditions, depending on what business cycle we're in. So when you go through a bad business cycle of low growth, the economy is sluggish, the businesses on the right-hand side tend to do a lot better. And when you're going through a very strong cyclical recovery, the businesses on the left-hand side from a stock market point of view will do much better. So what tends to happen is that if your style is aligned to a certain macro, then accordingly your performance increases or decreases accordingly. So it's not like the fund manager's IQ is going up and down. It's just that sometimes his style is aligned to the macro environment and sometimes it's not. Now, the challenge with that, what I realized, and this is to address Kamal's point of some learnings along the way, one big learning for me was the fact that investors will keep coming and going out of your funds, and invariably they come when your performance has been good, and invariably they'll go when you go through a bad patch of performance. And that's why there's always a friction cost or a difference between the performance shown on a piece of paper versus the performance actually experienced by investors. And to some extent, that's also why mutual funds, still, despite some really good long-term track records across multiple fund houses, yet, mutual funds, there are a lot of people who are still critical of mutual funds because their experiences haven't been as good. And to our mind, that's largely because of, how funds are sold or positioned, and people tend to follow performance. Now, I'll tell you a little story here to put that in more context in terms of how we've sort of experienced it firsthand. So when I joined DSP, Merrill Lynch Mutual Fund is what it was called when I joined in 1997. At that point, if somebody had told me in your career, Anup, over the next 20 years, you'll generate close to 20% CAGR return versus 15% CAGR for the market, that's the alpha generation over a period of time, I would have thought, decent job done, value created for unit holders. So, that's a nice thing to achieve. Now, when we actually completed 20 years in 2017, I thought of actually writing to all the investors, thanking them for being with us through that journey. And I was quite shocked to discover that of the lakhs and lakhs of folios we were managing at that point, the total number of people who had stuck with us for that entire journey of 20 years and 20% CAGR of performance, the total number of people were 24, just 24 people. And of those 24, some of them were there only because they had forgotten that they had invested. Otherwise, they would have probably got out much before. So the point, again, it brought to the fore is that the performance we were showing on a piece of paper was hardly experienced by anyone. So we could be very happy with our 20% CAGR over 20 years. But the fact is, what's the point of it if it's not been experienced in real life by the investors? And the reason is, again, what I mentioned recently, which is our funds probably attracted more flows after they had performed well, and then attracted redemptions when they were not doing as well. So there's a big gap between what investors get and what the fund shows on a piece of paper. So what I realized, the learning from that is it's not good enough just to produce performance, but you also have to try and be as consistent in your performance as possible. There's no point producing absolutely top of the line performance, being a hero, and then money comes in after that, and then you deliver horrible performance, and you sort of go from hero to zero type of thing. So the whole idea is, how do you be consistent through cycles? And that's why this framework gives us that flexibility, rather than being biased on one side or the other only. By doing this, by keeping that flexibility between defensives and cyclicals particularly, we think we have the ability to navigate through cycles. So for instance, in recent times, we've reduced our defensive component in the portfolio and moved further up on cyclicals. And so we're more in the top half now versus the bottom half. And that's how we'd rather operate through this particular cycle. We don't want to give up on our good secular businesses, but we can see obviously a cyclical element coming back into the market. So that's how this whole framework evolved. It's through a combination of a lot of the experiences of the past. And as well, we've obviously tested this quantitatively, which I'll show you right now on the next slide. So this is the backtesting of these results. And so we started with effectively data from 1996. So in 2006-07, to qualify the companies into SCDB framework on the market then, it required previous 10 years data. So these are companies based on the previous 10 years, and then every year it sort of rolls over by a year. Now you'll notice that the secular businesses every year, this is their sort of performance year by year through that period of time. This is the defensive quadrant performance. So every year there'll be some changes. Something will move from S to D. So we rebalance every year. We look at secular, defensive, cyclical value traps, and then look at that portfolio performance. This is cyclicals and this is value traps. Now you'll notice secular, is mostly green or yellow. So most of the time it's performing reasonably okay. Whereas value traps, there are periods where they do really well, but for the most part it's dark red. So it's not really performing consistently. And between defensives and cyclicals, things, keep moving around once in a while. There'll be a period where defensives do badly, cyclicals do well, or cyclicals do badly, defensives do well. So in totality though, if I go through this entire period of time, the CAGR on average from seculars has been 13%, from defensives 10.6%, from cyclicals 6.5%, and value traps 3.2%. So that sort of gives you a perspective on why we think that SCDB is critical. Number one, by being overweight secular, underweight value traps, this gap to some extent we try and narrow. And by being tactical between these two, because there will be periods when there will be stark outperformance or underperformance, you are keeping enough flexibility in your portfolio to navigate through cycles and try and produce not just returns, but hopefully more consistent returns. Another factor I must tell you, because this is very important, and I just want to put a context to it because we're doing a product also around this. So the SCDB framework is the basis on which our current multicap PMS works, our focused equity fund works. But there's a sort of context I want to provide to it, which is that a lot of businesses are not static in those quadrants. They move. The quadrants themselves are quite dynamic. And there's a fair amount of churn. So you have to keep track of these changes constantly. So if you look at, for instance, over the last 10 years, there were 96 seculars 10 years ago compared to 11 now of that original list. So totally there are more seculars today, but there are a lot of them got listed in recent times. But it just shows you the starting point and the ending point and how much of churn has occurred. Now, interestingly, over the last 10 years, most of the churn has happened downwards. So the value traps have actually increased the most. There were 76 value traps at the start and they've gone up to 160. So it just shows you that economics of businesses have actually been falling consistently over the last 10 years. And therefore, more and more companies were actually gravitating towards the value trap segment. And obviously, were also underperforming consistently right through that phase. Now, the way we see things is over the next couple of years, you will have an economic upturn. This is, we have all the conditions in place for that. And as you get that, there will be some companies that will move up quadrants. So they will migrate from, let's say, cyclical to secular or cyclical to defensive, and further upwards, some will move from value traps also. So the whole idea was, given that there will be some of these movements, but we don't want to compromise our long-term framework, because we've seen consistently that over longer periods of time, sticking to our SCDB philosophy is the core. But what we did was, just looking at this perspective and the fact that you will have a phase where, as the economy moves, it's a sort of rising tide lifts all boats. So you will have some migration also away from this quadrant upwards. So we launched the Phoenix Fund, which is a recent product, which actually is looking for turnaround type of opportunities. So these are businesses that should have had a 15% ROE at some point in time, but today are trading much below that. But we believe that in the next 2 years, that quadrant can move up. So it's a bit of a one step going even further behind the SCDB and trying to preempt moves towards S and C and D. So that's what the Phoenix Fund is all about, but I'm happy to talk about it later when we're done with this conversation. So that's a quick perspective. And I think I had one more slide, which is just on the point I made earlier about the difference between fund returns that are shown and actual investor returns. And what we've noticed is the more volatile the category, so this is a study by Morningstar, the more volatile the category, the worse are the investor returns relative to the fund. So while, for instance, small cap funds have delivered a certain return, the average investor experience has been far lower in the same funds than the fund has itself delivered. That's based on the inflows and outflows that the funds have experienced. And we see this across the board. Consistently investors are actually underperforming the underlying fund returns. So sometimes the best policy, and we always say this, is just identify the right fund house, identify the framework, philosophy, the discipline around it, and then just stay with it idly through cycles. That's probably a better way to navigate. I think I'll just stop there actually. That sort of gives the whole context of the presentation. So let me just stop here and hand it back to you, Kamal.
Sure. So this was quite interesting. So I will now, first of all, ask the core question that is asked by most, investors these days, because what has happened over last 3-4 years in Indian context, not only in Indian context, even in global context, secular businesses are the ones which have been, participating the most, and they have been the ones which have been giving more consistent returns. And there have been very popular products which have come off late over last couple of years, which call these companies as consistent compounders. And that is where many investors who have actually made money in some of those names, right, are of the belief that why to get into, for example, cyclicals. If cyclicals is all about, say, banks like ICICI Bank, why get into that? Why not stick to, for example, a secular like HDFC Bank? Right? Why to get into defensives? And why to talk about value if one can easily see that yes, price is a function of earnings, and earnings are more predictable and more kind of foreseeable in the secular businesses. How do you address this particular question?
So again, Kamal, it all boils down to time frames of investing. If you have a 10-15 year time frame, sure, of course you should buy good companies. Of course, not the ability of a secular company to stay a secular company. I just showed you there's a lot of churn, so you have to keep monitoring that. It's not taken for granted. But having said that, if you have a very long-term perspective, sure, you buy good businesses, you eventually come out okay. But within that, there are long periods where you could suffer underperformance as well. You mentioned Unilever, I think. We all know the fact that Unilever actually underperformed the market for a 10-year period from 1996 to 2006. It was one of the worst performing index names. And what we've realized is most investors don't necessarily have the tolerance to sit through that entire phase. And invariably an action will happen and then they will step out of that theme. I had a last slide which I didn't show, but it shows the average holding period of funds. And what it shows is less than 50% of people hold funds for more than 2 years. Most people hold for a less than 2 year period of time, over half of the investing community. And therefore it does tell us that, there's a large part of money that doesn't necessarily have the same level of mindset of time as some of these strategies would ideally need. So that's where, again, as I said, it's all a personal choice, but I think having a bit of flexibility in that style and seeing opportunities, it's not like A company will outperform forever and B company will underperform forever. There will always be periods where things underlying change in certain businesses. As long as there's a core base economics in place and there's a decent management in place, I think there are cycles that tend to happen, and you can always sort of try and achieve higher returns through re-ratings or mispricing in the market that keeps occurring from time to time. So I mean, to again come back to your point, I think if you have a 10-15 year horizon, sure, but most people don't, and therefore having some degree of flexibility in the approach, at least for us, seems to make more sense.
Sure. So SCDB framework, has a history of more than 5 years in this context. So let me understand from you. Last 1 year has been altogether different, and everyone has had their set of learnings. And even QGLP, which is very famous philosophy pioneered by Mr. Ramdev Agarwal ji, even they say that they have evolved over a period of time. Has SCDB framework evolved over 2020? Has there been any changes in your philosophy and the way you will approach your portfolio now going forward for next 5 years, given the the event that happened last year?
No, not at all, Kamal. I mean, the beauty of that philosophy, as I said, is that it's able to accommodate different cycles. So, the S or the secular and the V value traps is something that is structural, and therefore we believe it over a long period of time. There's no doubt that, and I showed you those numbers, the gap between the two is very high, and there are reasons for that because of the underlying economics of those businesses. So therefore, that will always be core in our portfolio. But the ability to move between D and C, defensives and cyclicals, just allows us to navigate these markets better. So, we don't aim to be the number one performing fund every single year. But what we try to do is, as you've seen over a 5-year period, then, your performance comes through if you're consistent through multiple periods. So I think that's really the objective. It's not to have a portfolio designed for every single year. There will be years where the left side does better, the right side does better. You can't keep shifting your portfolio across. So we keep the core between S and V, those allocations. And between D and C is where we move depending on where we think the cycle is. So that gives us enough flexibility. So there's no requirement to change any of this from our core portfolio's point of view. We could do a tactical product like the Phoenix Fund, for instance, from time to time when we feel that there's a cyclical orientation and we want to allocate a lot more to cyclicals. So that's where a fund like this can come. And then we tell investors also that this is the context of this fund. So please understand, and this is the only 2 products we have. We don't even have a third sort of PMS strategy, so to speak.
Right. So, I understand that, yes, in comparison to other, for example, only secular focused portfolios, IIFL Multicap portfolio in terms of mutual fund, focused mutual fund or a PMS product requires a long-term horizon, maybe a 3 to 5 year kind of horizon or longer than 5 year horizon, and it works in that context very well. So my subsequent question to you is that SCDV, S, C, and D are fairly easy to understand. Secular businesses and cyclical businesses and defensives. But value is a theme, which is difficult to understand. And maybe in the current context, because we have seen, last 3-4 years have been very bad for India's economy. The GDP numbers kept coming down, earnings kept coming down, and then the event happened. And that has actually created a lot of opportunity in the value as a segment. And that is why maybe, you guys are launching a next philosophy or next product, which is centered to kind of take advantage in that context. So my 2-pointed question, is my understanding correct, or you want to refine it? And secondly, within this SCDV, why do you call V as value trap? It sounds negative, that you're trying to avoid that. At the same time, my understanding is that you're, finding kind of attraction in that, and hence you are kind of wanting to launch Phoenix, which is more, attuned to the current context. Can you please explain this particular point?
Yeah, sure. So no, they're called value traps for a reason, because that's exactly what they are. As I said, the longer you tend to hold them, the worse off you are. Again, I showed you year by year. There are some years where they'll do very well. There's short-term rallies. Obviously, they can't underperform every single year, but you can see how many red years there were as well. And the longer you tend to hold them, the worse off you tend to be, because that's the underlying economics of those businesses. So yeah, you got to be careful that they could be value, but they could also end up being traps from a long-term point of view. So that is the context of, so it doesn't, I mean, that's the philosophy, and we are very much sticking to that philosophy. What we're doing in Phoenix is not going into value traps necessarily. There may be some portion of the fund there, but only if we believe it will move up a quadrant. But the point was, in Phoenix is we also have a lot more C's and D's that can move up to S. So it's not like we're starting already with 45% S in Phoenix. That's the difference between that and the multicap PMS. So multicap PMS is always overweight on secular day one. So it will probably have a 45% weight today. And those are businesses we are very happy buying and holding from a long-term point of view. The Phoenix is trying to move one quadrant lower. So it has some S businesses, but much, much lower. It's not maintaining a big overweight on S. The idea is we're trying to find C's that can move to S, D's that can move to S, and some bit of V's that can move to C or D. I mean, the whole criteria is there has to be within a 2-year period a very high probability of a migration up in terms of quadrant. So that's the only thing. I mean, it's not like we're going and filling in value traps into Phoenix. That's not the idea. And we definitely don't want those types of businesses. So the Phoenix is actually designed around 5 or 6 parameters actually. So it looks at valuations which are trading below average, below the 10-year average. It looks at businesses where the current ROE is below its historic ROE, which should have demonstrated an ability of being 15% or above. It looks at businesses that meet a minimum forensic parameter for us. So we do forensics on every company, and the last 2 deciles are dropped out. It focuses on companies that could be seeing a potential management change. We find that to be a very important catalyst for changes in the economics of businesses. And it's also looking at businesses or companies where the price performance has either underperformed or it's significantly below where it used to trade at some point. So these are not necessarily all at all-time highs or something like that. So a lot of those criteria go in to select companies. So there's a base level of quality. We're not compromising the quality. We're not going deep into PSU banks, small, all those type of categories. We're not doing that. We're looking at businesses that can move up quadrants. So we're not going in with the starting long-term bias that we have of being very heavy overweight on, let's say, S, or not heavy overweight, but reasonably overweight from the index. So right now in the main portfolios, we will have S and C overweight. In this one, the C will be much more than our regular funds as compared to, and the S's might be a bit lower.
Right. In a normal course of fund management, for example, a fund is kind of focused on investing in cyclicals, or a fund is focused on investing in seculars, right? So obviously, the normal routine of the entire fund management team is to have their investment universe and then keep on building the investment universe in terms of doing in-person meetings or understanding the financials, and then based on the entire philosophy, mathematical and subjective, take calls. But in SCDB, it is a combination of 4 different philosophies in one particular portfolio. So how does daily routine of your team, this is a real question which, a few of my clients had asked me, and ultimately, they eventually invested in IIFL Multicap PMS, and they are today, very happy investors. But I do not know how I answered them then, but I will now have an opportunity to ask this question to you, right? Because what is the practical reality of the daily routine of your fund management team in terms of managing a portfolio which is maybe focused in terms of number of stocks and number of sectors, but fairly diversified in terms of, following investment philosophies?
Yeah, Kamal. So that's really the art of portfolio construction, really, which is how do you construct a portfolio that can be more consistent through time? And the whole idea of SCDB, see, the underlying economic characteristics that are common in the philosophy is that we're looking for businesses where the return on equity is incrementally rising, right? So we're looking for businesses that can move up quadrants, ideally 15% ROE or above, migrating there if they're below. So that is one common thing. We need businesses that the incremental return on equity is improving and to a number that is more meaningful. And then obviously you want to also buy them at a reasonable valuation. We don't want to pay any amount of money to own those types of businesses, because finally there's a price for everything. So that's the core philosophy that accommodates this strategy. And therefore you can look at each of these 4 quadrants accordingly. There are always good defensive businesses with ROEs that we can buy where the valuations make sense. There will always be some cyclical businesses that are going through a downturn but can come back up. And again, we focus a lot on quality within that also. It's not like we're going and buying some small cap cyclical with huge debt or something. We don't do that. So you can always find those. So a lot of our philosophy is around return on equity. From a financial point of view, is return on equity and the price to book in relation to return on equity. And there's a very simple rule of thumb: the higher the return on equity, the higher is the price to book. The market makes a lot of mispricing on price to book terms depending on the near-term return on equity. I'll give you an example of that actually, just again, so that it's easier for you to understand. We see this most starkly in commodity stocks. So for instance, in commodity stocks, if you pick up, let's say Hindalco. Now, when Hindalco is in the business of making aluminium, right? And aluminium is very power intensive. So it's a very capital intensive business. It takes thousands of crores to set up an aluminium plant. Now, what tends to happen is it's very economy sensitive business. So if your plants are, since it's so capital intensive, if the economy is not doing well and you're not selling anything, you have to still keep your plants running. There's a high fixed cost and your profits get impacted dramatically in a situation where your revenues are not growing. So in a bad time, Hindalco's ROE, for instance, fell down to 2-3%. In a good time, what tends to happen is, let's say production is running at full capacity. Again, your costs are fixed. Now all of that revenue goes straight to your profits, and suddenly your ROE is moved up to 15 to 20%. Now what tends to happen is, this is how the market psyche works. When your ROE is 15-20%, the market assumes that 15-20% ROE will last forever and will give it a 3 times price to book. When the ROE falls to 3%, the market will assume a 3% ROE will continue forever, and it will start trading below book value, because at 3% ROE, you're not even covering the cost of capital. So it will trade at 1/3 book. So, if Hindalco's book was 240 rupees, in the downturn when the ROE was at its bottom, it went to 80 rupees. In an upturn, when it goes up, it'll go to, premium to book value. That's how it moves. That's the anomaly of the market. Those are the mispricings that occur when people misprice the return on equity or the future return on equity or profitability of a business. Now, obviously, 20% is not the core return on equity, nor is 3%. The reality is somewhere in between through cycles. But the market will misprice it through every single cycle. It will assume high ROEs in a high cycle and low ROEs perpetually in a low cycle. So that's where you take advantages of mispricing, whichever quadrant you're in. It doesn't really matter. So that is where there's commonality, and we are able to pick and choose companies across these quadrants.
Whenever any question is asked from any fund manager regarding, what are the top sectors, in terms of choices, one sector that is always top for most of them is financials. And I see, the weightage of financials in your portfolio as well. So how does SCDB framework convey, and what does SCDB framework convey about financials? And you may take a couple of examples of stocks also. And let me give a disclaimer that we are just going to talk to understand. And if you are not comfortable with stocks, you may not. But the fact is, it is an educative question which I'm trying to understand, to build on the entire thought that and the topic that we are talking about.
Sure. So if you noticed in the quadrants that I showed you, a lot of financials were in the secular quadrant. And, we are fairly strong believers that somewhere down the road, if the financial services sector doesn't do well, it's difficult to imagine the market doing well, or indeed the economy doing well. Simply because from a stock market point of view, it is the largest single sector, more than 1/3 of the market. And from an economy point of view, a large part of this whole consumption story of India, which a lot of foreign investors are very bullish about, is very closely linked to financial services. Without retail lending growing, it's difficult for consumption to maintain its pace. And Bajaj Finance being the best example over the last 10 years of how consumer lending has evolved and how that has spurred consumption in the process. So financial services in that sense is a very critical sector, both from a macro and a stock market point of view. And we do believe that just in our journey as a country, the penetration of financial services is still incredibly low. Retail credit as a proportion of GDP in India is at 15%. So the total amount of retail loans in proportion to GDP is just 15%. Any emerging market you pick up would be somewhere between 30 to 50%. And any developed market you pick up would be 50 to 100% of retail credit to GDP. And this is typical as countries evolve and grow, the retail credit to GDP ratio keeps rising. So these are sort of decadal stories, frankly, ahead of us, where we still have to reach penetration levels that are more normalized for emerging markets, at least. So we think financial services is a very core sector. It can get split between the S and the C category because the more corporate-oriented banks tend to fall into the C category. The more retail-oriented banks tend to fall under the S category, just given the past experience. But what we're seeing right now actually is a scenario where over the next 4-5 years, we've finished a corporate cycle, a negative corporate cycle. And now both corporate and retail will probably fire. And therefore, the C-oriented financials might migrate into S because, the ROEs will start expanding. Today, a lot of the banks there have 9-10% ROEs, which will easily get to 15% ROE in the next couple of years. So there will be that re-rating and profit growth attachment, which will cause hopefully a decent accretion to the stock price as well, or market value. So we are finding good opportunities both within the S and the C for financial services. And we are also firm believers that financial services is not just a short-term story, it's a long-term key critical component of our market doing well as our economy doing well. You cannot be bullish on India and be bearish on financials. And the only challenge with that sector is it's very volatile because it's a leveraged business, the traditional banking business or the NBFC business. And to that extent, there will be volatility also associated with it, which is all the more reason why you have to have a medium to long-term view, because the volatility will dull itself out over a long period of time and you'll capture the returns. But if you're focused on the volatility in the short run, it can will produce a suboptimal decision. So it's very core to our portfolio. It will probably add volatility to our portfolio from time to time. But I think the reward or the returns it will add will substantially compensate for that degree of volatility.
Another common question that is asked, and a point which comes to my mind is to understand SCDB. How does SCDB framework shows an outcome in terms of the market cap of your portfolio? So when you run today an SCDB framework in terms of chasing those companies which either have higher ROE upwards of 15% or are entering into that category, based on your understanding of some of the factors which led the fall in earnings, but are again going to change, and hence earnings are going to come up and they may get re-rated. And so those are the companies that we will pick up. But let's again come to, for example, financials. Now within financials, the space has large cap stock also, and mid cap stock also, and small cap stocks also. So by explaining financials as a sector, you can kind of talk about overall portfolio in terms of market cap allocation.
Sure. So let me just give you a broad brush of how we allocate market caps, partly linked to these quadrants. So seculars, we're happy to own large, mid, small, the entire range. Cyclicals, we do largely or mainly through only large caps. In the cyclicals, the risk that we want to take is mainly on the large cap cyclicals because they're liquid. If things change, or you have an ability to change your position. And most of them, we want to make sure we're in cyclicals backed by well-known promoters and with an ability to navigate through various crises. We don't buy small cap cyclical names. The small cap component will tend to be more defensive for us. So when we go down the market cap chain into small caps, we don't want to buy heavily leveraged small caps. Even they will perform at some point in a junk rally of some sort, but that's where the biggest accidents happen. So the whole idea is that small caps, we'd rather buy good managements, clean balance sheets, low debt, but there's a growth phase that they can go through. Small caps generally are preferred because they can grow on a smaller base. So you'll find a lot of our small cap positions tend to be more in the IT, in the pharma area. The defensive type of areas is where our small caps are. Our cyclicals tend to be more large cap. To the extent we have some value traps, which are businesses that we think will become 15% ROE, they're also large cap. And our secular is a mix of large, mid, and small cap. So that's how, from a market cap orientation, it all comes together. And today we have, generally we operate between 60 to 70% in the larger companies and 30 to 40% in the mid and small companies. On financials specifically, since you asked the question, you'll notice most financials are actually mid or large. You won't find too many small financials because that's just the nature of their business. They tend to be mid or large cap. And the portfolio obviously tends to be more dominated by the large cap financials, particularly the banks. And to some extent now, even all the insurance companies are now pretty much large cap. It's the NBFCs that tend to be a little more mid cap. That's where you'll find more mid cap opportunities. And that's where if we find certain specialist areas like affordable housing that we like a lot, or gold finance, or some elements of microfinance, for instance, that's where we may buy a small or a mid cap financial in our sort of total aggregate of financial exposure. But it's dominated typically by the banks, the larger banks. And then you have these unique positions which are backed by really good managements, high quality, best in class return on capital ratios, where they've shown a track record of navigating through cycles as well. So that's how we normally position our positions, how we look at our stocks.
Right. Thank you so much. It's been very, very interesting and intuitive. Another question that comes to my mind is, from investors' perspective, I'm talking about an HNI or ultra HNI investor, who today has a choice of selecting between a mutual fund and a PMS. And as you said, you have only one philosophy as of now, and that philosophy is followed both in form of IIFL mutual fund and in time IIFL Multicap PMS, and both have fully good track record. So, if you are an investor, put yourself in investor's shoe, and the amount is not the point. That investor is trying to kind of figure out, but he's basically trying to build wealth, and he's trying to get better returns or maybe better risk-adjusted returns. How should one select between mutual fund structure or a PMS structure? Because you have worked for many years in the mutual fund industry, and today you are part of IIFL, which is more known for alternates. Right, that is where I am asking this question to you, because you can, and this is the question which is a real question which is in many investors' minds these days, and we deal with this question every day. So,
Sure. So like you said, both the funds are managed in pretty much exactly the same way. There may be some small differences in some of our small caps because you can't necessarily own the same small cap in the same proportion across all funds. So there will be some slight differences there. But by and large, the performances track each other quite closely. So frankly, we are pretty agnostic where investors come in. It's broadly the same strategy. I think it comes more with the investor preference to have some understanding of where their money is being deployed. So in a mutual fund, you get to know your portfolio only after every month end. In a PMS, you're seeing what's happening on a daily basis. So you just have that much more understanding, let's say, of your portfolio on a regular basis and how it's being managed. So that's, I guess, the only sort of difference, because we're not necessarily designing everything very differently. So but there's some advantages and disadvantages. The slight disadvantage of PMS versus mutual fund comes at, let's say in these during IPO times, for instance, Whereas a qualified institutional buyer, you have to be an AIF or a mutual fund. You cannot be a PMS, for instance. So you cannot participate in some of these issuances. So that sort of creates a little bit of a gap. Sometimes if you want to, you want to participate, you can only participate through one structure. You can't participate through both, ideally. Or you'll have to just participate in the main book, and we know how the main books get oversubscribed. So there are some of those little subtle angles between PMS and mutual fund. There's of course the tax angle, but that's assuming the PMS investor is managing his taxes well. If you're not, then mutual fund, at least whatever activity happens within the mutual fund is effectively not taxed. So your net taxation is only on the net gain. But that's a very personal prerogative. Honestly, the way we see it is, a lot of high net worth investors like that interaction with the mutual fund manager. They want to understand how you're managing the portfolio. They'd like to observe it, and therefore they prefer our PMS structure. So that's how it tends to work. But frankly, we'd be very happy to have them in our mutual fund structure or the PMS structure, because they're both managed in exactly the same philosophy.
Sure. Now we are coming to maybe last one or two questions. IIFL Multicap PMS comes in two options. One is a Multicap PMS, and other is Multicap Advantage PMS. Multicap Advantage PMS has a put option in place. So which one is suitable to what kind of investment objective or what kind of risk appetite? And if one has to select between these two, what are the various factors that one can kind of objectively think in terms of time horizon or in terms of expected return or any other factor that comes to your mind? How should one select between two choices that you offer?
Sure. So again, Kamal, the Multicap Advantage PMS, as you mentioned, has just the options embedded. So all it does is it changes your risk reward to the extent like it's an insurance policy. There's a cost to that insurance. So if the markets keep going up, that will be, it will lag the Multicap PMS portfolio, because that obviously doesn't have the cost of options. But occasionally, if the market falls dramatically, that's where the options come to the rescue and your drawdown is not as significant. So this is meant more for investors who have a lower risk tolerance and therefore want some protection into a large drawdown. So for instance, this happened last March, right? When the market sharply fell, the Multicap Advantage PMS fell a lot lesser and did really well for investors. But then as markets rise back all over again, those options again over a period of time start actually becoming a cost to the portfolio. So the Multicap Advantage PMS helps a lot when you go through a very sharp correction in a very short period of time. That's where suddenly the Multicap Advantage PMS starts looking like a much nicer fund at that point. But for the most part, in a rising market, in a trending market, the options will end up just being a cost. It's like an insurance policy, as I said. So net, it sort of creates a bit of a gap between the performance of the Multicap PMS and the Multicap Advantage. So what you need is the occasional big crash that makes Multicap Advantage useful. But actually, what should happen is once that crash happens and it's embedded into the performance of the fund, then owning those options don't make as much sense. So then you're actually better off in the Multicap PMS at that point. But it's difficult for people to keep shifting from one to the other. So anyway, it's all really down to the investor's ability to handle that volatility. If you're saying, listen, I don't mind slightly lower return, but I don't want like a massive drawdown in a big fall, that's the Multicap Advantage PMS product that is probably more suitable. And if somebody says, no, I have the time horizon, I don't really care about the volatility in between, then the Multicap PMS is probably the better place to be.
Sure. We are coming to the last question. Now, I'm not going to ask directly what is the view on market, but this is a very foremost question which people are wanting to ask. Anup, you being there, I remember, my Citibank days when every week, I think in 2007-8, I'm talking about that era, we look forward to hearing your phone call in those days when you were in DSP, mutual funds. And markets were interesting then also. Markets are interesting today also. So I'm not asking them what is your view on market, but I'm wanting to understand from you, from investor perspective. Today, investor has a choice of investing in mutual fund and PMS, and both structures in IFL offer staggered way of investing. You can do SIP in mutual fund, you can do STP in PMS, right? But what should be the right method in the current context? And this is an indirect way of trying to understand from your perspective, how do you view the market, right? So how do you answer this question?
Sure, I'm going to have to screen share again, Kamal, because I
Oh,
preempted this question with
please.
just try and share that with you. So, listen, we get asked this question a lot, obviously, and let me just make sure this is visible. Yeah. Now, let me just first give you a quick preamble to that. Number one, in my 25 odd years of experience, I haven't found anyone who gets market timing right consistently. And actually, if you evaluate all fund managers, including my stint in DSP, there are three sources of generating alpha for investors. One is stock selection, one is sector selection, and third is market timing. And almost there's no fund manager who generates value on market timing. So let me just be very clear. You may talk to fund managers as much as you want on asking their views on the market, but their ability to generate value for you with that view is very limited. It's really stock selection and sector selection that matters more. Now, having said that, what we say is that while we can't give you a clear market view, but we can give you perspectives on when the risk reward is in your favor or not in your favor. So this chart sort of explains it. So the first question, the first rule of investing, Warren Buffett himself says, is don't lose a huge amount of money. So we started with this point of, if you go through the last 40 years, we wanted to see how many times did the market fall by 30% or more. And there were a total of 7 instances, including last March. The next stage was to look at what was the valuation before the fall. And in almost all cases, what we saw was the price to book value of the market was above a certain level. Now, we use price to book, not P multiple, for the simple reason that earnings are very volatile and P will not ever give you a good indicator, especially when earnings are going through a big rise or a big fall. Price to book is a much, much more stable indicator. Now, what I've shown on this chart is a 20-year period of the Sensex price to book. And what we've observed is that there are ranges. We don't know where the tops and bottoms are, but you know that there are periods where the risk reward is in your favor and risk reward is against you in equity investing. So this sort of chart tries to explain that. So what we observed is, for instance, if you look at this red line, this is price to book of about 2.3. Whenever the market has come down to that point, 2 and let's say 2 times or below, the market spends only 5% of the time there. So we don't know how long it will spend, how deep it will go, whether it's a bottom or not. But what we do know is it's not going to stay there for very long. And the next 5-year returns on average, when you've invested at less than 2 times price to book, is 40% per annum, way in excess of what you normally expect from equities. Without a doubt, at those points, the uncertainty has to, by its very nature, be at its highest. Right? None of us had a clue last year what was going to happen with the pandemic, how long it would last. But that was the time to put some money in. The problem was the speed of this rally that nobody could get, but it didn't really give anyone enough time. But the fact of the matter is, anytime the market gets to 2 times below, there's a very good chance that your returns over the next 5 years are going to be far in excess of normal. For the most part, the market spends time between 2 and 3 times price to book, 52% of the time. And your 5-year returns are what you normally expect from equities, about 14%. Between 3 and 4 times price to book, 31% of the time, 11% return. So let's say between 2 and 4 times price to book, the market has spent 83% of the time with returns of 11 to 14%. This is a zone where it's pointless trying to figure out when is the next correction coming. Will it be a 10% fall, 5% fall? Because you won't ever be able to get in, get out. You're much better off, at least as a fund manager, doing bottom-up stock selection through these periods. As long as the market's in that zone, there will always be some good businesses to buy and some value within the market. It's above 4 times price to book that the red flag has to come up. That's where the market again doesn't spend too much time. So it's already in an overheated zone. And your 5-year returns compress dramatically. It's still a positive number actually, but much below what you would expect from equities and even below fixed income. So right now we're at 3.3 times price to book. To our mind, at 3.3 times price to book, we're here. Focus on bottom up. Don't really bother about where the market is going. If it's falling 5, 7%, 10%, so be it, it will recover also. But the focus should be really as an equity investor on more the bottom up selection that the fund manager is doing than the market direction. It's only if the market gets above this zone that you've got to seriously start worrying. And again, it's not necessarily a top. We've seen markets go even beyond that, as we saw in 2007-8. But you know the risk reward is against you, and at some point that won't last. So that just gives you the context of how we think about markets today. And therefore, as a person investing into the market right now, whether you want to stagger it or not, the question is, that's more your own mental comfort. That listen, normally staggering is the easiest way mentally because you're just doing it in an automatic, disciplined way and taking the emotion out of it. But if you can handle the emotional effect of a 10% fall here or there, then at this range, it's sort of a normal range that you would normally get a certain base return. And most likely, the market still is in a position where the returns are probably going to be better than fixed income for sure, just giving current interest rates. Also, please remember we're in the early phase of a very strong earnings cycle, and therefore that gives us more confidence that this valuation, while it may look optically a little higher, the fact of the matter is that these are not the conditions in which you get these 30% type of falls. So I just want to put that context to it.
Sure. Thank you so much. Quite insightful. And with this, everyone, we come to concluding this session. And thank you very much, Anup. We have today learned from you. Almost all the real questions have been answered with regards to a very popular SCDB framework. And I myself have learned a lot. And I'm sure the session of 1 hour in this discussion has been so interesting that if anybody would watch this session, question after question and answer after answer, it's come out really, really well. And to all our audience who have been so patient for last 1 hour, thank you so much for attending. Thank you, Anup, and thank you, everyone. Thank you.
Thank you, Kamal. Thanks for having me, and thank you, everyone, for listening into this call. And we'd be happy to follow up in the future in such series. Thank you so much.
It would be our pleasure. Thank you.
Thanks.